In today's market update, we're going to be taking a look at that troublesome 80-day cycle trough yet again, and then we're going to take a step back and take a look at the bigger picture, in particular the 40-week cycle and the way in which price is interacting with the 40-week cycle FLD. My name is David Hickson. Today is the 23rd of August 2019, and before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. So here is the analysis of the S&P 500 that we have, of course, been tracking. And in my previous market update recorded before the open of the US markets on the 14th of August, I spoke about how it was possible that the 80-day cycle trough had formed on the 6th of August, which is now presented as a fact on this particular analysis. However, it isn't as certain as that because, of course, of the way in which price is interacting with the 20-day FLD, which is this purple line over here. And in my previous market update, I mentioned that we were expecting a G category interaction in which the 20-day FLD is expected to provide resistance to price. I mentioned that if price did find resistance at the level of the 20-day FLD and moved downwards, then that would probably be labeled as a G category interaction. I also showed the 10-day FLD, displayed over here, that's that pink line, and discussed how when price dropped below the 10-day FLD, that would confirm that the interaction with the 20-day FLD was a G category interaction and that price was now in an H category interaction in which it moves down and away from the 20-day FLD towards the 80-day cycle trough. And so if we were going to be sticklers and go absolutely by the rules, that would have been a G category interaction, and this here would have been the H category interaction as price moved down towards the 80-day cycle trough. The very next day, price did in fact form a trough and bounced back up again. You can see how the interactions between price and the FLD give us a slightly different way of looking at the market and understanding the analysis. Is it possible that the trough that formed on the 15th of August is in fact the 80-day cycle trough? Yes, it is possible. I'm not going to discuss it at length in this video, but you should know that one of the things that Hurst mentioned is that the trough, although it might be lower in price, is sometimes displaced. And so in fact, the identification of the 15th of August as the 80-day cycle trough is a perfectly valid one. Most people would argue, and I am one of them, that the more prominent price trough is really better labeled as that 80-day cycle trough, but it is certainly possible. So let's take a look at a chart that presents that possibility. Here it is over here, and you can see the nest of lows for the 80-day cycle trough over there. Of particular interest is the fact that the trough on the 15th of August formed exactly above that circle for the 80-day cycle trough. Now that circle marks the exact position at which the cycle trough is expected on the basis of the recent, or sometimes called current, wavelength of that cycle. And so if we measure the number of days, you can see that was at 73 days. And if you have good eyes, you can see at the bottom right of the chart over there that 73 days is the recent or current wavelength of the 80-day cycle. So we have two possibilities, an 80-day cycle trough on the 6th of August or an 80-day cycle trough on the 15th of August. There is also a third possibility, shown in this chart, which I also showed you in the previous market update, which indicates that the 80-day cycle trough is expected pretty much early next week. Now, if this is the correct analysis, then we would expect price to come down fairly hard and fast to form that 80-day cycle trough. In my opinion, this analysis is becoming less and less likely with each passing day. If we count the number of bars since the 20-week cycle trough on the 3rd of June, you will see there have been 81 days. The average length of the 80-day cycle is 68 days, and so this cycle would be running about 13 days long. Not impossible, but it's fairly long. And the recent wavelength that you can see at the bottom right-hand side of the chart is 73 days. So it's either way you look at it, it's a pretty long cycle if that trough hasn't formed. In my opinion, that trough probably has formed. And so let's go back to one of those charts to discuss what we're expecting to happen next. If the 80-day cycle trough has formed in the market, then the next interaction between price and the 20-day FLD is of course expected to be the A category interaction, in which price bounces out of the 80-day cycle trough and heads up towards a target generated by price crossing of that FLD. As I mentioned in previous market updates, I was not very enthusiastic to jump into a long trade for this A category interaction, because I wasn't expecting it to be a particularly impressive one. So let's speak about some of these targets, and then I'm going to discuss why I'm not actually expecting this 80-day cycle to be a particularly impressive one in terms of bullish moves. So if the 80-day cycle trough occurred here on the 15th of August and price crossed up above the FLD as it did on the next day over here, then that target would have been at a level of 29.37. That level was just reached yesterday, and so the minimum target for that particular move has been achieved. Of course, if the 80-day cycle trough occurred on the 6th of August, then we generate a slightly higher target because it had further to travel up to the 20-day FLD, and that is at a level of 29.77. There is another little wrinkle in this consideration, which has to do with the fact that price dropped below the 20-day FLD on Tuesday of this week and then climbed back up above it. And so we have a multiple interaction between price and the FLD, and the way in which we handle that is we choose the mid-level to generate our target, and doing so we get a target of 29.71, I think it is, and 3011, which is about over here. So the best target for this A category interaction is just up here above the level of 3000. So why have I not been too bothered about missing this A category interaction? Well, that has to do with the bigger picture and what I expect out of this 80-day cycle. So let's speak about that. Here is the chart zoomed out, going all the way back to the 18-month cycle trough at the end of December last year. And if we display semicircles, then we can take a look at the 4 80-day cycles that are expected to elapse within the first 40-week cycle following that 18-month cycle trough at the end of December. There are the 4 80-day cycles. Now, our expectation for each of those cycles is slightly different because of the way in which the multiple cycles work together. So the first 80-day cycle following the 18-month cycle trough is expected to be very bullish because of the pressure of all of those longer cycles, the 20-week cycle, the 40-week cycle, and the 18-month cycle that are also pushing upwards. And so we get a very bullish 80-day cycle. There is the simple up and down movement of that 80-day cycle, and you see it was very bullish. The next 80-day cycle is expected to be less bullish because although the 40-week and 18-month cycles are still pushing upwards, the 20-week cycle has turned down. And if the 20-week cycle is a particularly strong cycle at the moment, then you would expect to see a much weaker or much less bullish 80-day cycle, which we did. That is a fairly neutral cycle. You can see that the level at which it started is pretty much the same as the level at which it ended, and the peak occurs just slightly after the midpoint. So that's a fairly neutral cycle, certainly much less bullish than the first cycle. Our third cycle is usually expected to be a little more bullish than the second cycle because of the fact that the 20-week cycle is bouncing up again. And if that 20-week cycle is fairly strong, it's going to give it a good lift upwards. But it's not expected to be anywhere near as bullish as the first cycle because, of course, at this point, the 40-week cycle has turned down. Now, what is our expectation for the fourth cycle? Our expectation for the fourth cycle is that it should be the least bullish of all of the cycles, because for this fourth cycle, the 40-week cycle has turned down and the 20-week cycle has also turned down. The 20-week cycle has been quite a strong influence on this market. And so if that 20-week cycle has turned down, then this next 80-day cycle is expected to be the most bearish or least bullish of all of these cycles. And so our expectation is that this 80-day cycle will probably not achieve a new high. It will probably turn down earlier than the halfway point, and it is likely to head down into a lower trough for the formation of this 40-week cycle trough, which is expected, as you can see, towards the end of October, maybe early November. And so that is my expectation for the 80-day cycle. That's why I'm not really very excited about jumping into long trades. I would certainly be much more interested in looking at the short trades that are coming up. Now, there's another reason why I'm more interested in the short trading opportunities that are going to be coming up over the next month or two, and that has to do with the way in which price has been interacting with the 40-week FLD, which I touched on in the previous market update. So let's take a look at that. When considering interactions between price and the 40-week FLD, we expect a similar sequence of interactions between price and the FLD as we track in the 20-day FLD. However, there is a little bit of a change in the sequence of interactions, and that has to do with the harmonic ratio between the 18-month cycle and the 54-month cycle. If you don't know what that means, don't worry about it, but make sure that you download the document that explains the core concepts of Hurst cycles. I will make sure to add a link to that in the description below. But the important point in terms of this discussion is the fact that there are generally considered to be 3 18-month cycles within each 54-month cycle. There are many analysts who believe that in fact the harmonic ratio should be 2-to-1 between a 36-month cycle and an 18-month cycle, because usually the second 18-month cycle trough, which was this trough in December of last year, is much more prominent than the other 18-month cycle troughs. But let's take a look at the sequence of interactions, and I will explain how they differ. Following the trough of the 54-month cycle, which was probably in February of 2016, we get an A category interaction where price crosses up above the FLD, achieves its target, and then comes down in a B category interaction where price finds support at the level of the 40-week FLD at around about the time of the 40-week cycle trough. Then the C category interaction is as price pulls up and away from the 40-week FLD. The D category interaction is as price moves down into the first 18-month cycle trough. And the E category interaction is where price moves up and away from the FLD. Now usually the D and E category interactions are expected to carry price below the FLD. So what does it tell us that price didn't manage to get below this 40-week FLD at that point? Well, you know the answer to that by now, I'm sure. It tells us that there was a lot of bullishness in the market. Now, this is where our sequence of interactions changes, because we have an extra 18-month cycle in the middle here. And what happens during that extra 18-month cycle is that the sequence of interactions actually repeat themselves. And let me demonstrate. We often find another B category interaction where price comes down and finds support at the level of the 40-week FLD at around about the time of the 40-week cycle trough. I label that B2. Then we have the C category interaction as price moves up and away from the FLD. I label that C2 because it's the second C category interaction in the sequence. Then we get a D category interaction as price crosses down below the FLD, and an E category interaction as price crosses back up above it. And those I also label D2 and E2. Now the next interaction in the sequence is expected to be an F category interaction, which, as you know, provides us with a good short trading opportunity as price moves down into the next 54-month cycle trough. So there is the nest of lows for the next 54-month cycle trough, which, as you can see, is in about the middle of next year. And so if this sequence of interactions continues as we expect, then we would expect price to drop down below that FLD and move down into the middle of next year, which is another reason why I'm not feeling particularly bullish at the moment. But now, I don't want to make this video too long, but there is a subtlety that I should point out here. And that is that my level of confidence in this analysis is actually only at the level of the 18-month cycle. I'm not very confident about the position of the 54-month cycle trough over there. Although the sequence of interactions looks fairly good, it is just possible that the 54-month cycle trough would be better positioned over here, and I know there are several analysts who believe this. In which case, if December of last year was the 54-month cycle trough, then our interactions are different, of course, and we have an A category interaction over here, and this here is a B category interaction, providing us with exactly the opposite expectation, which is that the market is going to keep rising. That is a possibility that we need to keep in the back of our minds. In my opinion, it's not the most likely possibility. More likely is the fact that the F category interaction is forming at the moment and that the market is going to move down. But now this FLD, as is the case with most FLDs, provides us with a wealth of information, and I would like to demonstrate something else to you without making this video too long. I'm going to do it as quickly as I can. Let's go back to this interaction over here. When price crossed below the FLD at this point, which was of course the D category interaction, we were able to generate a target to the downside of 25.22. Now, as I've mentioned before in these market updates, when price fails to achieve a target or when it exceeds a target, it's not arbitrary information, it's very useful information. And in this particular case, the price move downwards exceeded that target by 183 points. That tells us that there was a bearishness in this market, and the bearishness was at the level of cycles longer than the 40-week cycle. So in other words, the underlying trend, which is a combination of all cycles longer than the 40-week cycle, could be rated as being bearish by an amount of 183 points. The next interaction between price and the 40-week FLD was over here, and we could again generate a target that was the E category interaction, and you can work out these targets for yourself on your own trading platform. That target was at a level of just above 3,200. I think it was 3,207. But something interesting happened with the peak in July. It, of course, has not yet reached that target of 3,207, and it's quite possible that it will continue upwards and reach that target, although I think the chances are fairly small. What is particularly interesting is the distance between the target and where price actually reached, which is a number of points that is equal to 179. So here's how this works. There was a bearish influence on the market resulting from a combination of all cycles longer than the 40-week cycle in December of last year, which amounted to negative 183 points. The market failed to reach the target generated by the E category interaction by a very similar amount, an amount of 179 points. There's only a 4-point difference. Now, it is possible, of course, that if this was a longer cycle trough over here, that the underlying trend of the 40-week cycle has changed from being bearish to being bullish. But the accuracy of those numbers makes me think that that is not the case, and that we still have a negative underlying trend. We have a bearish underlying trend of about 180 points. Remember that the underlying trend of the 40-week cycle consists of really long cycles, and so the pressure that those longer cycles exert on the market changes very slowly over time. And so for me, I find this a very convincing argument to the fact that the next interaction that we are expecting is an F category interaction, and that we are going to expect price to resolve downwards and move towards the next 54-month cycle trough in the middle of next year. That is another reason why I'm not really looking for trading opportunities to the long side. If we go back to a daily chart and consider again the 20-day FLD, you can see why I've not been very excited about the potential A category interaction that we have just experienced. I'm also not very interested in the C category interaction. Of course, eventually when price manages to achieve its target or fail to get there, we will see a B and then a C category interaction. But the more interesting interactions, in my opinion, and the better trading opportunities are going to be the short trading opportunities, in particular the D category interaction when price crosses down below that 20-day FLD. I do hope that you found this market update interesting. Thank you very much for your interest in Hurst cycles. If you have any questions or comments, please do post them below this video. I look forward to seeing you on the next one.